In this video, we want to get an introduction to stocks and answer that question of what is a stock? In the world of finance, and within the three major categories of finance, stocks are related to two major categories, corporate finance and personal finance, specifically in the investments arena. So what is a stock? I want you to think back at a time that you went to a party or had a family gathering and you had some pizza. At that gathering or that party, you probably ate one or two, maybe three pieces of pizza. You probably did not eat the whole pizza. So the slices of pizza that you ate were your share of the pizza. Similar to that analogy, the pizza can represent the entire company. And you can buy a portion or a slice of that company, which means you have a share of that company. And when you purchase a share of a company, that means you become what we call a shareholder of that company. So a stock is an ownership in a company. We oftentimes use the term equity when we refer to stocks as well. So you would have an equity ownership in the company. Let's look at an example of how this works. If I buy 2 shares of the company at $10 a share, that means I spent $20 for those 2 shares. In other words, that is what we call my basis. The money that I put up front to buy those shares of stock in that company. Now let's say that the company performed really well that year. And now the price of those shares, or I should say the individual share itself, the price of each share, rose by $5. In other words, the price appreciated to $15 a share. It used to be $10 a share. The company performed well, so the price of that share went up to $15 a share. So what does that mean? Well, that means that since I own 2 shares of the company, each at $15, the price, or in other words, the value of those shares that I own now, is at $30. Then I subtract out the basis, or the money that I put in up front to purchase those shares, and I have a $10 gain, which means I earned $10 on that investment that year. Now, that is one way in which we can invest in a company and purchase stock and have our investment increase and earn a return. Another way that we can earn a return by investing in stocks is through what we call dividends. Dividends are payments to the shareholders that invest in that company's stock. Not all companies pay dividends, but some of them do, and they oftentimes use dividends as an incentive for investors to buy the stock. Dividends are commonly paid to investors on a quarterly basis or sometimes on an annual basis. So let's look at an example where we incorporate the 2 ways that we can earn money on investing in a stock, both by price appreciation and through dividends. If we look back at the example that we were using earlier with the 2 shares of the company that we bought for $10 a share, and then the price increased by $5. It appreciated by $5. So the value of one share is $15 a share. And then the company pays a dividend of 25 cents a share. That means if I own 2 shares, the dividend payment to me is 50 cents. Putting it all together, we see that our capital return, in other words, the appreciation or the gain or loss that we got on our stock investment, is $10. Our income return, or in other words, the dividend that we earned on that investment in that stock, was 50 cents. So our total return is $10.50 on the $20 investment we made. And here's how we can look at this from a percentage perspective. We can take our ending value, which is the price appreciation. We subtract out the basis, the money we put into the investment, and we can add in the dividends or the income that we got from that stock investment, if there is any. And then we divide all of that over our basis, and it gives us a return. If we put the numbers here into perspective, then we can see that we have our $30 ending value minus our basis plus the dividend divided by the basis of $20. If you do the math, you'll see that above the line is the total return. That is the $10.50 divided by the $20 that we put into the stock. So we returned 52.5% on our investment, given that we're not accounting for any taxes or other factors in this situation. Now, it's important to know that companies can offer 2 types of stock: common stock and preferred stock. So what is the difference between common stock and preferred stock? Simply speaking, the difference depends on the benefit that the shareholder is looking for. For example, common stock shareholders have the right to vote on company decisions, on some of them. However, a downside to the common stock is that you don't get your dividend payment until after the preferred stockholders do. So preferred stockholders may get paid the dividend first before common stockholders, but preferred stockholders don't have the right to vote like common stockholders do. And similar to companies having the ability to offer different types of stock, there are also different types of companies. Similar to deciding between different types of pizza to choose. For example, you could have thin crust pizza, or you could have a deep dish pizza. Now, these pizzas on the screen here, I'm not saying are overly appetizing, but the idea here is to understand that there are different types of companies as well. So to get a basic understanding of the difference between growth companies and value companies, growth companies are commonly those that are looking to expand. They oftentimes take the profits that the company earns and rolls that back into the company to expand, maybe make some new products, expand their inventory, and grow the company. To where value companies are commonly known to offer dividends rather than plow the money back into the business. It's not that they don't plow no money back into the business, it's that they may not put as much money back into the business as growth stocks do. So it's important to know the difference between growth stocks and value stocks, because it depends on what type of investment you're looking for. If you're looking for a dividend payment within your stock investment, you may look for value companies. To where if you're looking primarily for appreciation of the stock price, you may look for a growth company. A few other important key terms to note are first initial public offering, or IPO. That is essentially the term that is used when a company is offering their stock for the first time. And when they do that, they offer it on what we call the primary offering or primary market. Another term is defensive stock. Defensive stock is a type of stock that is bought by investors when the company is involved in stable products for economic conditions, such as food or healthcare. Then we have cyclical stock, which is a type of stock that a company sells discretionary items. And discretionary items are known as items that are not those necessities, those bare necessities that we need for life. They are oftentimes vacation or luxurious items that we don't necessarily need all the time. And then another term that is important to remember is stock sectors. Stock sectors means that we are grouping or categorizing a group of stocks or companies by their industry that they are in for business, such as energy, technology, healthcare, financial, and so forth. And that concludes this video for what is a stock as an introduction to stocks.